I think we'll start. Well, welcome to this seminar on behalf of the Institute of Environmental Studies and the Centre for Energy and Environmental Markets. I have to apologise that Ian McGill and Maria Palatra couldn't come. They're both, Ian's in Tokyo and Maria's at the conference, so it was difficult to find a date when everyone could be here. So we'll go ahead then. So this seminar comes at a very exciting time. At the international level, as you know, President Obama and President Xi have announced an agreement on climate action that will certainly assist the international process next year in Paris. And at the very local end, a petition by the staff and students to the Vice-Chancellor and Council to divest its investments from fossil fuels has been very firmly rejected, and on the grounds that fossil fuels will be needed, and I quote, for many years to come, and also on the grounds that this is allegedly a political action to divest, but then so is investment. So from the global to the local. So I'm really delighted to introduce Tim Buckley. Tim is going to speak about the transition to a low-carbon economy and the financial risks of stranded assets. Tim is Director of Energy Finance Studies Australasia in the Institute of Energy Economics and Financial Analysis, and he works in the low-carbon finance space, looking at both the risks to potentially stranded fossil fuel assets and the opportunities and valuation of renewable energy. So Bill will make his presentation, and then Tim will be joined by Bill Hartnett, who's Head of Sustainability at Local Government Super, for the panel discussion with you. So over to you, Tim. Thanks.
Perfect. Thank you. So I should probably stay near the mic, should I?
Yes, if you stay near the mic, and you can either use this or this to advance the slides.
Wonderful. So good afternoon, everyone. So thank you, Mark, for inviting me, and thank you, Sue, for organising all the logistics. So as Mark said, I'd like to talk about stranded asset risk and the transition of the global electricity market, and within that, a subset which is the thermal coal market. So I thought in addressing that question, I'd try and cover off on 6 areas. I'll probably go through it relatively quickly so we've got plenty of time for questions, and we can always come back to the slides if you wanted to delve into them. And a copy of the presentation is available afterwards, and it will be recorded. So I thought I would cover off on the massive transformation that is already underway in the global electricity market. That might surprise you given the rhetoric we read in the Australian press, but to me there is already a massive transformation, and it's towards a sustainable lower carbon structure. To me it's an inevitable transition that's well underway. It's inevitable because of the pressing and critical need of climate change, and the world has to address that, but it's also inevitable for a number of other shorter run factors, and primarily addressed by the factor of self-interest. Air and water pollution and the associated health costs are definitely a driver, but to me the bigger driver is in fact energy security. It's self-interest that is driving countries to move very rapidly. It's not evident in Australia because we don't have an energy security problem. So you look at China, you look at India, you look at America for the last 50 years, and you look at Germany, they have huge energy security issues. So that is the political imperative that's driving a lot of their actions. I'll aim to cover off on the state of the thermal coal markets. As I said, that's a subsector of the electricity market. I'll address very quickly both the physical market and then the equity market, which is a reflection of what's happening in the physical markets for coal. Coal has historically been the mainstay of the electricity industry. So as Mark said, there is this imperative. Coal will be with us for decades to come. even on my optimistic scenario, coal will be with us for decades to come. I have no problem with that statement. It's inevitable because there's trillions and trillions of dollars already invested in the status quo, the existing asset base. So to me, the debate is only how much more do we invest in stranded fossil fuel assets before we transition to a lower carbon, more sustainable structure. And it's that transition and the speed of transition, the new investment that I'm watching, and that's what gives me the optimism. So you built a coal-fired power station 3 years ago, it'll be operating for the next 30, 35 years, almost inevitably. So when Tony Abbott says coal is going to be with us for decades to come, I actually agree with him. That's the only point I do agree with him on. And I think his conclusion will be wrong in terms of the implications for Australia. But my biggest forecast last year was that China will hit peak coal consumption in 2016. At the time I made that forecast, probably going on 2 years ago, I was an absolute outlier. It was totally non-mainstream thinking, and everyone said, you've got to be joking, it's not going to happen. China's building a coal-fired power station every week. How can you move away from coal? Now, 2 years later on, I'm actually quite crowded with the space around me from global investment banks who actually share that view, and I'll give you a couple of data points to illustrate that. So, to me, 2014 is an absolutely pivotal year, and I look at China for almost everything that I do, and the reason is China is half the world's consumption of coal. So what happens in China drives the global coal market. In 2014, GDP growth for China is 7.3%. Electricity growth is still 4%. I'll come back to that ratio maybe, but that's a big difference, but it's still growing. Electricity growth this year is 4%. Coal consumption in China is down 1%. You have a total disconnect between the growth of the economy and demand for coal. And that is an absolute pivotal moment in history that I think will be replicated going forward and will transform China dramatically over the next 15 years. So, moving on. Just quickly through a couple of these slides, and if you can't read them, as I said, they're available afterwards. So, thermal coal market. For 50 years, it was running along at $30, $40 a tonne. It spiked up to $200 a tonne in 2009, 2008, but since then it's dropped 60+%. So something has fundamentally changed. The cost structure of the industry is such that, so this is the Seaborne thermal coal market, 2014, free on board, US dollars. It's gross cash cost, so it's before sustaining capex, before return to shareholders, before paying off interest. The black line is where we are today. And the dark blue bars, these dark blue are the Australian coal mines. So what that is saying is that 2/3 of the world's coal market is actually losing money at the cash cost level at today's pricing, and most of Australia's coal mining is losing money. That's a huge change. One of the problems that's extenuating this issue is that rather than the usual industry response, you have an oversupply, you have weaker than expected demand, you cut back on supply. But the coal mining industry's gone the opposite. They've said, let's ramp supply up. It's actually commercially logical for each company, but suicide for the industry, because ultimately what they're after is we've got to get the cost down. We can't live with that cost curve, so we've got to drive the cost curve down. Economies of scale, 101 economics says, increase production, keep your fixed costs steady, and you'll get a lower average cost of production. So all the coal companies have been ramping up production aggressively, driving costs down individually, but leaving the market oversupplied. So, my comment is coal is in structural decline. It has actually been for 3 or 4 years. The equity markets are increasingly agreeing with me. So I thought I might just illustrate with a couple of share price charts. On my background, I've been a financial analyst for 25 years, so I study the equity markets. So when I look at this chart, the red line is the Australian stock market. Not great, flat for 4 years on average, but the coal stocks are the ones I'm looking at. So blue is Whitehaven Coal, and then I've thrown in a couple others. Bandana Energy, they went into administration 2 months ago. They were $1 billion hopeful only 2 years ago, now bankrupt. Cockatoo Coal this week, yesterday, announced that they've suspended their stock pending an announcement. So it's going to either be a massive recapitalisation or they're going into administration as well. Down 95% in the last couple of years. New Hope Coal actually stands out. That's the light green one. They've actually been a massive outperformer. That's because they've got $1 billion net cash on their balance sheet. So if you take out the net cash, they've done the same. They've destroyed 75% of their coal value, but cushioned by a strong balance sheet. But my point is that is representative, in fact, of the global coal market. So this one is the American market. Peabody, Arch Coal, Alpha Natural, 3 of the 5 biggest producers of coal in America. America's the second biggest coal market in the world. Coal consumption in America is down 20% in the last 6 years. So the coal stocks are likewise down 80+%. I find it bizarre that only one company in the world was invited to speak at the G20. Anyone want to guess who it was? Peabody Energy, the world's biggest private coal company. Tony Abbott is all for coal. Tony Abbott talks to Peabody. Peabody gets invited to talk to the 20 biggest leaders in the world about the future of coal. Peabody has destroyed $13 billion of shareholder value in 4 years. They're down to $3 billion market cap. They've destroyed, I'll say it again because I think it's actually quite an important number, $13 or $14 billion of shareholders' capital has been destroyed in 4 years. So they're the blue line, down 80%. If you're lucky, you just left your money in the cash. Otherwise, you could have actually stuck it in the stock market and made 60 or 70% return on your money if you'd avoided Peabody. Why am I picking on them? Because they're the only company advising the G20 about the future of the energy market. So I would actually say they're a wealth hazard and they should actually be looking after their shareholders because they're doing a pretty lousy job at the moment. And that's what that chart tells me. I'll go a bit harder on this. Peabody, if you didn't get the point, Peabody has, 10,000 ex-workers. They have a huge pension fund. Unlike Australia, we're gifted with Paul Keating's legacy, which is a massive funded superannuation scheme, $1.8 trillion worth of assets, mostly funded around Australia. I mean, I'll talk about universities, but everywhere else. So Peabody has an $800 million retired workers pension plan. Of course, the board has looked after their workers, right? They've funded it to the tune of $0. Not $1 has gone to fund the retired workers pension plan. So if and when Peabody goes bankrupt, the retired workers are screwed. It's an inappropriate word, but that's the word for it. But don't worry, the chairman is the CEO. He's looked after his board, he's looked after his management, he's fully funded their pension plans. So there we go, there's my dig at Peabody. I just find it bizarre that our Prime Minister takes advice from Peabody. China, same story. I think you probably get the picture. Coal is in structural decline. The equity market is telling you that. Okay, renewable energy. Put a positive spin on it. I'm actually very optimistic, despite, or maybe because of, my understanding of renewable energy. And Australian universities have actually led the world in the development of renewable technology that is transforming the electricity market, whether Australia believes it or not. So, pure economics is what my background is, finance and analysis. That's what gives me the confidence. Economies of scale and technology combined to give you an absolute transformational event this last decade, equivalent to the mobile phone's impact on telecommunications. That is what we're in the middle of. So for all the doom and gloom in the renewable industry, in the last 5-6 years, you've seen global renewable installs go from 58 gigawatts in 2008 to 100 gigawatts 2012 to 138 gigawatts on my forecast 2016. Some people question, is hydro renewable? We could debate that if you like. I put it in there. And that to me says the world is transforming, whether Australia believes it or not. There has been fits and starts without doubt. There's been huge policy shifts and countries have gone really hard and then taken the foot on the brake. So Spain, Germany, but they've driven the technology, they've driven the economies of scale, and therefore they have lowered the cost of the technology to the point where it is now grid competitive in certain markets like Australia. So renewable energy, one of the key points I find staggering is renewable energy is deflationary. It will transform the world's inflation environment. After 100 years of fossil fuel inflation, renewables is deflationary. Just ask RWE or E.ON, two of the biggest utilities in the world, a decade ago, how deflationary renewables are. The IEA roadmap, which came out in September, free online, you can get it. It's really worth reading because the IEA admitted they were wrong in September and they doubled their forecast for solar's impact over the next 35 years. They've now forecast solar is going to decline by 5% per annum for the next 35 years. Yep, 35 years, 5% compound decline. So in the next 15 years, solar is going to halve. They're wrong because they're too conservative. Wind, not as much because it's a mature technology, so it's still deflationary, though not as dramatic as solar. Last point on renewables, solar and storage combined will just absolutely leverage the whole situation. So distributed solar with storage is coming to Australia. It's coming within 2 or 3 years. It's coming the day this factory starts because Australia is the most obvious market for distributed solar to come with storage. Tesla is an inspirational story. 5 years ago it didn't exist. Today its market cap, $32 billion. Best performing stock in America of the majors, probably actually best performing stock in the world of the majors for the last 5 years. And they're building a single factory which is bigger than every battery factory in the world today. Someone pointed out it's actually the biggest building in the world that they're building as well. Tesla likes to do things by scale. But why they're doing it? They want to transform the battery markets very rapidly. They want to cut the price of a battery by 30 to 40% in the next 3 to 4 years. That's transformational, given they're already by far the lowest cost battery buyer in the world by a factor of probably 60, 80%. They're going to drop it another 30 to 40%. And when they build one, their plan is to build 5, 10, 15 of these factories. And that's how many they need for their own internal use if they're successful. So, using up my time, peak coal demand, I think you've probably got the point. China is at peak coal demand in my forecast already. America down 20%, as I mentioned, since 2007. India still growing, I'll come to that. And Europe flat since 2000, but major policy initiatives have been put in place, they've been strengthened this year, and they've said coal decline permanently in Europe from now on at the sort of rate that America is going to see. I won't go through this chart, but what it says is China's electricity system is transforming before our eyes. You just have to look at the numbers on the left. 2012, 79% of electricity came from coal. 2014, 73%. 2020, my forecast, 60%. Coal will represent 48% of the electricity capacity by 2020 in China. It will peak in 2016, which is why coal consumption will peak in 2016. Solar, wind, hydro, nuclear, gas, everything other than coal is the Chinese Premier's strategy. Not just myself. Citigroup forecasting that China will get to 62%. So he's wrong, he's too conservative. I talk to him quite regularly, he's a good guy. Interesting, Goldman Sachs, I just got this morning. Goldman Sachs did a mea culpa, they've got it wrong. They've downgraded China's coal consumption by 2018 by 20%. In other words, coal peaked 2014. I'm too conservative now. Goldman wants to go more aggressive. We've actually peaked this year, and I'm actually thinking they might be right. I might have called it 2016. It might actually have occurred today. Depends. Jury's still out. They're still opening coal-fired power stations every month, so they've got the capacity. The question is, do they need it? And coal is a high marginal cost supply of electricity, so it'll be squeezed out first, which is obviously what Goldman's looking at. India, great white hope for the coal industry, the Australian coal export industry. You're probably all fully aware, because the Fin Review told you, that the Energy Minister of India came out on Wednesday and said India plans to cease importation of thermal coal within 2 to 3 years. We all read that, didn't we? Of course not, because that's not in Australia's interest for India to actually do it, but that's what their energy plan is to do. Cease the importation of thermal coal within 2 to 3 years. You read a week ago that the Energy Minister came out and said he wants to spend $100 billion on solar and wind within the next 4 to 5 years. Now, these are huge numbers. He wants to spend $50 billion transforming his grid in the next 4 to 5 years to accommodate all of the solar, wind, the flexible supply. You need an upgraded grid to facilitate transformation. So they're huge numbers. He's got every intention of doing it. Why? Self-interest. He needs diversity of supply, he needs local employment, he needs to get off imported products, all economic reasons. Cost is coming down dramatically. So stranded assets, maybe in the last minute, that's actually my focus. So if you take my conclusion that coal is in structural decline, it makes no sense for Australia to be building tens of billion dollars worth of new coal mines for export, or railway lines for the exportation of coal, or ports for the expanded exportation of coal, all of which will serve to flood the market that's already oversupplied, already collapsing, and we want to double Australia's exports of coal? Like, let's kill the industry as fast as we possibly can. That's what Tony Abbott and Premier Newman are actually saying. Let's flood the market, drive the price down, drive the existing mines bankrupt. That really makes a lot of sense. Stranded assets. I mean, Wiggins Island is an example. This is Abbott Point. That will become the world's biggest coal export facility in the world if Premier Newman gets his way, but the banks aren't that stupid. They're not going to fund it. So Wiggins Island, they did fund that one, 100%. It's not even been commissioned as yet. It's Wiggins Island coal export facility, 27 million tonnes. It's a $4 billion new coal port that's being built in Queensland as we speak, commissioned next year, and it's a total stranded asset. It's the most expensive coal port in Australian history. Its utilisation rate is forecast by the industry to be about 40–50%, and if it's 40 to 50%, then it will become a $26 a tonne coal port rather than a $13 a tonne, which is what they modelled, and the Australian average is $5 to $6 a tonne. So it'll be 5 times the Australian average because of lack of throughput. It's already bankrupted Bandana Energy before it's even started. Cockatoo Coals and Trading Holders I mentioned, they are two of the owners. They've underwritten a $4 billion expansion of Wiggins Island. That is the ripple effect of the stranded assets work. So I might leave it there. One final chart. Electricity demand in Australia is going down. It's been going down now for 6 years. The regulators got it wrong for the decade. You'd think the regulator might review their model because each of those lines is a forecast since 2006 saying demand's going to grow ever upwards. The black line is reality, and that's Origin Energy's own presentation from last month from the CEO, and he's saying it's going to decline, and AEMO is now getting it at least ballpark right that consumption of electricity in Australia is in structural decline. They push the price up so far, energy efficiency is cutting in, people are moving away from it, they make solar cost effective. You open Tesla's factory, Australia is its first target market, so therefore the decline becomes permanent because people will just do self-consumption of solar storage. So on that note, thank you.
Thank you very much, Tim. Now, before we open this up to discussion, I'd like to invite Bill Hartman, Head of Sustainability at Local Government Super, to introduce his position, and then Bill and Tim will handle questions.
Okay. Thanks. G'day, everybody.
Sorry, could you speak over here with Mike?
Yep. This is all unattributable Chatham House sort of stuff, but it's all in the press as well. I work for Local Government Super. We've done a lot of things in sustainability and climate change. I'd like to think we've got a lot more to do as well, but I suppose a good friend and contact of Tim and a studier on that. And why is it that we look at climate change? Well, for us, there's two main reasons, and one of it is alignment with our members. Our members are in local council. They do a lot of sustainability type work. And two, we really see what we call in our industry ESG, environmental, social and governance issues, as being long-term risks for investors. And of that, my board has decided that climate change is without doubt the biggest long-term risk for our investors. So this is very much a story that is key to our area of fiduciary obligations of what we're doing. Super funds are a really interesting area. If you're not, I can see you yawning all about it as I say that. And well, the sustainability part of super funds are very interesting, and it should grow. Look, what makes super funds interesting from a sustainability perspective? And I'm actually here today because I am an alumni of the Institute of Environmental Studies. I was a frustrated fund manager type investment banker 12 years ago until my wife-to-be told me to get a life, and I went and did this and been able to get this role with local government super. The reason why we're different is that we're a very different type of investor. In fact, we're very different from any. We've got a wonderful mandate and wonderful privilege, one that we don't always fulfil well because nobody fulfills it very well, and that is that we have a mandate to think long term. We are looking after people's money. The industry is looking after money for, well, today, but also for 30 years, 40 years, 50 years if you go into post-retirement. So we've got a great privilege to be able to do that. It means we've got to be future-looking. The future's not the same as the past. You can't just extrapolate it. We've got this great theme of universal ownership, if you've heard of that one. It's a wonderful one, but really, we've got a lot of money, and problems in the world are not due to lack of money. There's a lot of money in capital markets. It's just making the money speak to the problems. But because we have so much money that's going out there, we've got to be very well diversified. But when you're diversified, it means that you will get the negative implications of something like a coal overproduction over work in the production of coal mills. You are any sort of negative externality that you will can contemplate. In the end, superannuation members' funds are taking the hit on that over the long term. GFC is another great example of poor behaviour in financial markets. Who pays the brunt of it? Your superannuation money does. So we've got this real mandate and an increasing fiduciary obligation to do things around how to address this. There's a few things that you can do. You can invest in low carbon type economy investments. We've done some of that. You can look at efficiency in your own investments. You can, property is a very good area for that, really great dollars and cents story. You can also look at engaging with companies, and you can also look at divesting. Divesting, as Mark was saying at the beginning, is a very hot topic. It's risen out of America that, a group 350.org is saying that you should divest of everything, every fossil fuel asset going around. And that causes a few heart rhythms and problems for a lot of people, because basically I can look at my portfolio, because I measure my portfolio, and I've got 20% of my assets, my equities are high carbon, what I would classify high carbon. That's about 8-9% below what my classification, and again, the classifications aren't perfect yet, we've still got to develop a methodology on it, but we've intentionally got it 8 or 9% below what the benchmark or the average super fund we think would be. So we're trying to get some sort of hedge to say, well, we've just invested in today's markets and in today's economies, and this is a really unintended consequence. People haven't been bastards and say, well, let's fry up the earth. This is just something that we're just coming to in a slow realization. But we want to try and be on the other side, and we want to try and facilitate change. So our view on fossil fuels is we use all these sorts of tools that I said to hedge our risk for our investors. For example, have just supported a climate change activist to go onto the board of BHP because we think all boards should have climate change skills. He got 1.5% of the vote. But it doesn't matter. We've had very interesting conversations with BHP on how they're going to actually address climate change risk. And I suppose and that's eventually what we want. So our thesis, and it's all based basically on what Tim is saying, is that there will be mining around in 20 years' time, but there'll be a hell of a lot fewer mining companies. And that's basically our projection on coal is something like this. Companies think it's up like this, and they're talking their book. So as a prudent long-term investor, we want to be in those companies, support those companies that we think are going to be there around for the longer term, and avoid the ones that we think are just going to well, tank, for want of a less technical term. So we introduced a high carbon sensitive screen, which was levied really at looking at the most exposed and vulnerable companies in the sectors most exposed to climate change risk. So for us, it was 33%. Any company earning more than 33% of their business in coal mining, oil sands, the Canadian oil sands is great industry, very interesting industry, and coal-fired utilities. And it's a 33% basis. We just were able to do that. I could get it from my investment committee. It took me about 2 years' time because basically we looked at those figures and you're saying you're better off, your members are better off not being in those sectors. So this is why superannuation is starting to get interesting. A lot of NGO contact is starting to come through on that. It's been a very lacking of transparency type industry as well. So I think I'll stop there, but that's the sort of things that we've been doing.
Okay, that's great. So thank you, Tim and Bill. We're now open for questions and comments.
Just need to make sure that we direct the microphone towards
That's going to be tricky.
So maybe
We'll just go through that.
Thank you.
Okay, sorry.
Oh, hang on. Yep. Actually, I'm not sure the mic's on. You happy?
Okay.
Given the performance of the coal companies that we've just seen, why have you gone to 20% rather than 0?
That's a very good question. Because eventually you start making a decision. It was 33% that we did. We wanted to get the companies that we thought were most exposed. I could go on about, well, BHP earns about 12.5% of its revenues from coal. I think my board would be very concerned about getting rid of BHP entirely from the investment portfolio in terms of meeting our long-term investment objectives. You start with figures, you start to see risk coming through. You know, I'm proud that my board has actually made this decision to make a screen that is actually, you know, right in the face of the most powerful industry in Australia, and we've got away scot-free. But it's an iterative process, is what I would like to see, as we start to improve our methodology on determining what is climate change risk, what is, and how to address it. You know, the other tools I was saying, it could go down. We'll see how the dynamics of the market keep on playing out.
Did you want to comment?
I'll admit I'm a financial analyst, and having done it for a long time, I can cherry pick data. You can always make data tell whatever story you want. So I'll admit that. I've done it for a long time. Coal is the easy one to hit.
Yeah.
It is a lot harder to talk about gas. It's a lot harder to talk about oil. It's easy to talk about oil sands in Canada. I mean, that's just stupidity. That's lunacy for the world. It's lunacy for the economics of the projects. But to talk about oil per se, very different equation. To talk about gas in America, my firm actually refuses to talk about gas in America. We do in Australia. We're actually launching a report next week on gas, because gas is hurting the Australian industry, domestic industry. I can come back to that. But in America, it's transforming their economy. So you pick your battles. I suppose I'm starting with coal. It's the easy one. Coal is showing that we will have climate action. We will have policy action. Eventually, oil, gas will be hit. But we wish it would happen earlier. But the reality is economics doesn't actually rule against it at the moment.
Yeah.
Bill, it was 3 years ago, 2011, when the coal price was so much higher and coal companies were doing well. Do you think you still could have got this through your board, or is it the two things happening at once?
I've got a very fortunate board where I work who've always been very progressive on this. It would have been harder. I mean, this was 2 years' worth of work to get the screen on. We had introduced a member choice, and this is, I should say, it's across our entire fund, so it's a view of the fund. It's not just a little satellite view of a member choice. It would have been more difficult just getting the data, understanding, you know, that screening through 1,800 companies, understanding who's got the coal, who's got the, you know, the gas, who's got, it's a whole new area that we're looking at. But certainly when we started the project to review all our screens, they were saying, you know, if you find new areas that you think are interesting, then bring it to the board, and that's how we've gone.
Just a question on the Australian market. It seems that the Australian stocks have been underperforming since 2008, say, in comparison to the US stock market. And I'm just wondering if that's partly because of Australia's increasing, we keep investing in the stuff that's losing money, i.e. coal, etc. Is that the reason for Australia's flattened performance in comparison to the US? And they're more adventurous and more willing to take a risk on the new technologies?
Yeah, I say I'm an optimist most of the time. I got 3 children, 2 of them heading towards university, 1 already at uni. I'm starting to get worried about the Australian economy for the first time in my career. We've had 50 years of unimpeded economic growth for Australia. We've got the strongest banking system in the world, dare I say it. But, sorry?
I believe you'd get out of banking quick.
No, absolutely. I'm not saying going forward, but historically it's been the bedrock. The funds management industry is probably the most strongest fund management industry relative to the size of any economy in the world. But, as you've just said, we've wedded ourselves to an industry that is the industry. We're going down with the ship. And the longer we destroy the instruments of transition, the harder the transition is going to be. And that's my message when I'm talking to politicians, that the destruction of the transmission mechanisms means the cliff's going to be that much steeper for us when we go off. And China's seen the cliff and they're trying to avoid it. Whether they will or not, who knows? But they're at least trying to get off the fossil fuel wagon. Australia's just tied our mast to it. And we keep hacking into the research and development staff. We keep hacking into the EPA. We try to undermine the CEFC arena. We're trying to make sure the REC's absolutely sidelined. So we're actually trying to do everything, we being the Australian government, we can to actually stop the transition of our economy. Germany saw it a decade ago, Spain saw it a decade ago, China saw it a decade ago, Obama saw it. But he's got our problem. He's got a Congress that's like our Australian government, so they're trying to fight him.
Tim, I just wonder if there's more evidence of the absolute substitution drivers, because in my mind you could argue that what you're seeing in all that data is a correction to a ridiculous series of booms. Like the Chinese went crazy with oil consumption through all the industrial development. The Americans have substituted a lot of gas. There's not it doesn't seem, you can see why the top volumes would be coming off in Australia's case for obvious reasons, but the substitution to me is not a definite.
Yeah, let me throw a chart up to explain, or partial answer to that. And as I said, I actually don't study gas per se as an industry, but this chart, one of my colleagues presented it, and it just struck me how true it is. When we talk about the Australian economy going towards a cliff, gas is transforming the American economy, yet what's the Australian government doing? It's trebling the wholesale price of gas for our domestic industry and consumers. So America, they've halved the gas price, we've trebled it. Yeah, that's great economic planning. Let's deliberately put in place a plan that says gas is now really expensive. It cannot be the transition fuel because it's too expensive. Whereas in America, it's $4 a unit. Australia, it's going to $10 a unit. We've had 50 years at 3. So let's give away our competitive advantage. What this chart is doing is saying that gas for the electricity sector in Australia, we were using 200 units. EMO is now forecasting we're going to drop to 80 units within 3 years. So we're going to decimate the gas-fired power generating plants, having just watched Origin, AGL and True Energy invest $10 billion in this sector. They're stranded assets within 5 years of them investing the money. So we're building stranded assets far faster than anyone really thinks. So I don't know, I might have lost your question in there.
Sorry, well, it seems to me you're implying that there's a fairly solid trend towards renewables and away from carbon-based fuels. And it just seems to me one of the explanations for that data is in fact that there was an excessive burn in those consumptions, and that's what's coming off. And the growth in renewables is a more natural trend than solar in particular based on price. And I just wonder if you've looked at any direct drivers of substitution in that sense.
Irreversible is what I would say. Solar has come down by 8% in 5 years. It's forecast on cities' numbers to come down another 50% in 6 years. I agree with them. and that makes solar so much more cost competitive, delivered to the end user. It's already cost competitive. I mean, what's the price of power in Australia to us? Average 28 cents a kilowatt hour. You put solar on the roof, it's 15 cents. The cost wholesale in Australia is 4. So what we buy for 28, they produce for 4. Solar's at 15, and so the industry says, oh, solar's not competitive against 4, but I can't buy it for 4. You guys can't buy it for 4, you buy it for 28. So versus 28, solar's a walk-in, lay down misère. You put storage in, you can use it at night, 9 out of 10 nights, because okay, it might be overcast or rainy 1 in 10 days, so you might actually rely on the grid for a tenth of your electricity, but you'll self-produce for 90% of your electricity. It's inevitable. There's a great paper in America which says that if an industry is going through structural change and driven by technology, there's 2 choices. You can use the regulator to stymie the change, or you can run with the change and try and get ahead of it. If you use regulatory barriers to stymie the change will happen anyway, and you'll get destroyed in the process. If you run ahead of the change, you can actually profit. And the study is not in electricity, it's actually in trolley cars in San Francisco, it's in cable video on demand in America. It's on other industries that have gone through the same sort of technology shifts that we've seen, and it's all about the incumbents' reaction. Do they fight it or do they go with it? Our incumbents are fighting it. China, they don't have the choice. They don't have a choice of fighting it because the Chinese government's telling them you're going to do it no matter what. So they do it, and all of a sudden they find it works. That's a long answer, but...
I mean, examples of that, you could think of investing in Telstra 20 years ago when it was floating. Would you go poles and wires, or you'd go mobile phones? You could go, you know, the railway companies were pretty cranky when cars came along as well. So, you know, it's a very similar sort of way of defending them. But that blip there was caused by huge investment by the Chinese and, you know, opening it up post-GFC. But it just means that it has created such a big supply that now with the headlines of, you know, demand is not going to be as big. That's why, you know, that's why we sort of avoid. The newer companies don't have long-term contracts. They don't have, you know, their higher costs. They probably aren't well enough resourced to, you know, deal with license to operate issues as well. So you just see that there's going to be big tanking on a lot of those companies. Whereas, you know, some of the more established companies who are more diversified will stay. But one of the things around demand that I think is pretty interesting in this area is, and this is all it is, it's about coal and its future. You know, I'm actually quite a big. If I was going to ask myself what the price of oil, the last barrel of oil is, I don't know what it's going to be. I know what the last ton of coal is going to be, but I don't know what the last barrel of oil is going to be because it's you know, it's got some very important functions that it plays in global economies. But if I was, the one thing around demand for coal, and you see it a lot, is this whole idea of coal for energy and poverty alleviation, because it is a cheap form. I see some grimaces going on in the background there. And the basis of this, it is a very cheap form of energy, particularly when you don't have a full carbon price on it. But one thing that even Tim hasn't picked up on this one, so I'm going to bring this one out. But, you know, I've asked a few big companies, where's this demand going? What poverty are you actually trying to alleviate? And they don't get too specific on that, but what I would say is that the World Bank and a lot of these supranationals agencies, that if the poverty alleviation, if the demand for coal, and we do need, you know, energy is such a fundamental thing to alleviating poverty. I mean, I think that's a very strong goal that we should have, but it's not going to come from coal. The World Bank refuses to fund coal-fired power stations and grids in frontier markets. So if you're looking at sub-Saharan Africa, if you're looking at India, World Bank, development banks of the UK, they're not going to be a cornerstone financier. So I don't see where that growth and how the coal industries are going to expect it to do it. This is why also, just another plug for sustainability and superannuation being a very groovy area, but you can actually invest in emerging markets infrastructure where they're doing, you know, you can give mandates to private equity managers looking at energy in emerging markets and energy supply and invest in the infrastructure there. They're not investing in coal. Solar and wind is there already. And it's, you know, so really to me, that's not just a blip, that's a structural decline that is really going to be quite strong and quite terminal for coal.
John? Yes, look, I'm very interested in this stranded asset because that's been discussed in Europe by youth. And it is a puzzle to anyone living in this country where we have announcements just this week that the Galilee Basin project looks like it will go ahead with a massive amount of government investment in infrastructure.
Rephrase it, subsidy, taxpayer-funded
Yes,
subsidy.
that's right.
It's not going to go ahead with investment.
Why is the market, which one thinks of as least being ruthlessly rational in what it puts its resources in return, are being sort of kind of lured into this investment by a government which is, from an ideological point of view, has got a vested interest in the coal industry. It does seem to be a paradox of some great folly that the financial media, the superannuation funds will not jump up and say, this is mad. I mean, the discourse around it seems to be truncated, if not paralyzed.
Just remember the wool industry, John.
Yes.
Australia went down. We stockpiled wool for decades.
That's right, yes. We should have learned by that stage. We know this is folly, even though it's ideologically attractive to the constituencies of the government. It does seem to be financially ludicrous.
That, I suppose, it goes a bit to the point of what I was saying, how superannuation funds are very different, or can be very different type of investors. Because most investors are very transaction-based, getting in there, doing a deal, floating something up the stock exchange. Fund managers being very short-term, they've got to, markets move immediately, but they don't notice the sort of systemic macro risks that come through. And in regard to some of the stuff you're seeing up in Queensland, there's been several banks that have said that they're not going to fund that now already. So we'll see how the rubber hits the road and how it plays out.
I mean, the irony is the Newman government's had to come out yesterday and announce that they're going to subsidise the opening up of the Galilee because the response is the financial community won't fund it. So why won't the financial community fund it? It's not commercial. 8 global banks have said they won't fund it. So yeah, I just find it ludicrous. We have actually analysed it from every angle because unless you understand why they're doing it, you mentioned ideology, that's the core to it, but Newman keeps going, it's about jobs. Now, that is actually his motivation. He truthfully believes, I think, in his own mind, that crap. It's because there's no other word for it. When you open the Galilee, you're going to push the coal price down about 10%, at the least. I'm probably being conservative, you might lower it 15 or 20%. What is going to happen if coal mines on average are already at cash flow break even and you push the coal price down 10 to 20%, then you're going to find a whole lot of Australian coal mines close. Now, one of my colleagues rudely said, New South Wales versus Queensland. We produce in New South Wales thermal coal, they produce coking coal. So Newman doesn't worry about the fact he's going to close a whole lot of mines, thermal mines in New South Wales. And unfortunately that's true. They don't actually produce much. They're 80% coking coal. But that's how short-sighted it is. So for every mine that opens in the Galilee, 10 or 20 mines around Australia will close. So the job outcome will be 0. And in fact, Adani has appointed a Korean firm and an American firm, and yet they advertise they're creating Queensland jobs, 10,000 Queensland jobs. I'd like someone to challenge them at the ACCC and say, well, where are these 10,000 Queensland jobs going to come from if you've employed a Korean firm and an American firm to build the project?
He's talked a lot about Australia as a problem, not so much about the solution. I'm just wondering about, obviously there'll be a lot of consolidation in the sector from the major providers. What about price controls or price regulation that can actually string out the price equation over a long period of time and try and smooth the effect of the
Yeah, you're presuming, well, you're talking as though the government's going to do that. I mean, the government's denying there's a problem, so... Yeah. Okay, China up until now has been a major importer of coal. Japan is a major importer of coal. Korea is a major importer of coal. So Taiwan is a major importer of coal. So do they care if we oversupply the market? They're actually happy because the price of the product they're buying is going down. They in fact fund expansion of new coal projects because they want the market to be oversupplied because they're the buyer. And our government says, please come in and screw the market for us so that we can get lower prices. So if you're thinking the Japanese or the Chinese are going to be the saviour of the Australian industry by sensible regulation, I'm probably misquoting what you're saying there, but no, it's in their interest for us to oversupply the market.
But I'm talking about an open price solution for
Yeah, collusion. It's not going to happen. Glencore actually proposed last month the takeover of Rio or the merger of their Hunter Valley coal operations for exactly what you're saying. So their logic was get the two biggest coal producers in, well, two of the four biggest in Australia, put them together. You can sack a good 5,000-10,000 workers on the back of that. That'll create a lot of jobs. And you can get the cost down 15-20% on the back of it. And you can get some OPEC type power. So oligopolies are better at protecting themselves. The coal industry is very fragmented. It won't do anything for price. It will only just allow them to lower the cost, which will then lower the long-term equilibrium price. So I'm against it because it will just screw Australian workers quicker than they're going to get screwed anyway.
There's too many substitutes for coal as well. You know, there's not as many substitutes for oil, so that's where it makes it much more vulnerable.
Could you tell us a little bit more about the battery price? You said it was 15 cents. That's without a battery pack. If you've got batteries, what does for continuous supply, what sort of price are we looking at? What's the future for batteries, and when Tesla is going to produce their batteries, please?
Yep, it's a big question. I'll answer it quickly. Batteries will hit Australia massively 2018. Why? Category 2018. Every second house who has solar on their roof will have a battery in their garage 2 years later. Why Australia? Why so quickly? A, the factory doesn't open until 2017. They'll spend a year proving the technology. The Germans are already proving the technology for us. The Germans are great at leading this charge for us. So, I'm saying that in all sincerity, they've done wonders for the world's renewable energy. This factory opens 2017. Tesla, Elon Musk, multi-billionaire, visionary. He's up there in my eyes with Warren Buffett and Bill Gates. He's just visionary. And he will allocate maybe a third of this to solar with storage so that he can get the technology really ramping up, and he'll put it into Australia first because our peak electricity price is 50 cents. So forget 28, we've got to actually shave 50 cents off. We all have a vested interest to put batteries in our garage. So what's the price of the battery? At the moment, the answer, I can't actually give you hard numbers because if I tried to buy a battery off the shelf today, I'd be paying $1,000 a kilowatt. He's paying $180 a kilowatt. Today, he being Tesla, Elon Musk is buying $180 a kilowatt. It would cost me $1,000 to buy the same battery. Funny that he's the biggest buyer of batteries in the world. He's going to lower the price to $100 a kilowatt. What's he going to sell it for? He'll choose probably 120, 150, and he'll sell it into the retail market, and he'll sell it into Australia at 150. So the price of batteries will drop 70% by 2020, and Bob's your uncle will all be 90% independent of the grid, whether the grid likes it or not. The more barriers Origin, AGL and True Energy put in to stop us, the faster we'll do it as a nation.
Just a very quick comment on going independent of the grid. Solar's my background. You need a very big battery bank and maybe the price will be low enough. But if you've got 5, 6, 7, 8 days of cloud and rain,
Yep.
Having a little bit of grid is a good thing. So I think I'd be interested to explore, if anyone is interested, how does the grid survive into the future? People will do little bits of storage, I think,
Yep.
just to get them from the daytime to nighttime. But longer than that, I think there's going to be a lot more stranded assets in having overcapacity batteries to go independent. Going off the grid is a big ask unless you put another generator in to back you up on bad times. But
agree 100%. I would say maybe 1 in 10 Australian consumers will go off grid, and even then, probably not even that many. I said Australians will reduce their electricity from the grid by 90%, not 100%. Why bother going off grid? As you said, it's not commercially viable. The grid's there. They're going to make us pay for it. We'll be taxed so that we can fund the grid because it becomes a stranded asset because it's resisting the change. My argument to the New South Wales government is privatise the grid, but don't allow it to have barriers to technology change that we know are coming so that we all stay on the grid and we just use a hell of a lot less of it. And I said, by the way, while you're actually privatising it, write it down because it's already gold-plated, it's already overvalued. So write it down so we don't get taxed as much going forward because we're all going to pay for that. It's a $20 billion asset that we as New South Wales taxpayers have funded and will be funding it for the next 20, 30 years, whether we like it or not.
Yeah, I was just wondering, with the big downturn in coal prices, does it eventually become competitive again? Is there a point at which it does sort of find its level?
Yeah, it's a good question. I actually, when I'm talking, depending on the audience, I actually would prefer the coal price was $75. That's my long-term forecast for it. I mean, like Bill said, it'll go to zero, but in the medium term, it will go back. Well, you didn't say that. I'm saying that's what you said. You implied it.
the last time, but there's a lot of time to go yet.
So, but it'll go back up first for exactly the reason you make. But you only have to look at the last solar auction in India. Anyone know what the price was? 6 rupee per kilowatt hour for solar. First Solar from America is happy to produce as much solar as India wants at 6 rupee per kilowatt hour. Price of electricity in India from imported Australian coal at $65 a tonne, 6 rupee per kilowatt hour. Domestic coal is 2 to 3 rupee per kilowatt hour. So India will use a hell of a lot of coal as much as they can from their own domestic sources. They can't afford imported coal. The system just actually financially can't justify it, which is why the energy minister has come out and said we're going to have to wean ourselves off imported coal. We just, as an economy, they've got a massive inflation problem, they've got a massive current account problem, they've got a weak exchange rate. Economics says they have to wean themselves off imported coal, just like they have to wean themselves off imported kerosene, and that's exactly what they're doing. So the price of solar is coming down faster than the price of coal is the answer.
Sarah, and then Melissa.
So if coal consumption in China is going to peak in 2016, and as you said, India can't afford to import Australian coal, it's way too expensive. So you don't think that India's going to take the place of China?
Coal industry certainly hopes they do.
Yeah.
I certainly don't. When Minister Goyal says I want to encourage $100 billion to be invested in renewables in the next 4 to 5 years, and he categorically means it, that's going to transform the solar industry yet again and drive the cost down, and he knows that. He wants to install 100 gigawatts of solar in the next 10 years. So, yeah, India doesn't need coal. They've actually got more coal-fired power stations. What Modi actually wants to do in the short term is actually get the coal-fired power stations that they've built. They've spent $100 billion building coal-fired power stations. They're all running on average at 60% utilisation. So Modi's first objective is to try and kickstart the economy. He needs electricity and he needs the power sector actually to start making money again because they're all hemorrhaging cash. He has come out with a plan which has pushed the utilisation rate back up to 80-85% without spending a cent of new capital. That gives him 3 years of extra supply of cost-effective, and he'll use imported coal for that process. So I think that 3-year game plan won't work. I think it'll be 5 to 10 years before they wean themselves off imported coal. But Modi's trying to work out how we can actually blend the coal import and domestic and try and feed it in without causing rampant price inflation. And their initial numbers are 50% increase in the retail price of electricity. That's really going to help inflation, isn't it? And that's their own numbers, that's not mine. So they just can't afford it.
So can you sort of see a transformation of the Chinese economy from a manufacturing economy to a service-oriented economy, because that would also impact.
Yeah, that's just thinking. It's categorically part of the solution. Why I'm so confident it's going to happen. It's happening already. China has 5-year plans, and they actually generally adhere to them. They actually make them totally available. You can read them online, and they actually make sense. They have a plan. We don't have a plan as a country, which I find bizarre. But they will transform their economy, and that.
Manufacturing industry is going to go.
Yeah, so one of the arguments the coal industry hits me with is, oh, we're just going to squeeze manufacturing out of China and push it down into Southeast Asia and just relocate the problem. At the moment, China is 50% of the world's consumption of coal. Asia is about 2%. So Asia can double, and on my forecast will double its consumption of coal in the next 12 years, 10 years or so. It'll double again and again. But Asia doubling and doubling again, in the meantime, China, America, Europe are all coming off. Japan's coming off. So in other words, 4 of the 6 biggest users of coal are collapsing their demand. Asia's starting down here and will build. And then what they'll do is piggyback solar. So they'll skip the technology, as Bill mentioned, and just jump straight to solar with battery storage in 2020. So I'm pretty optimistic Asia's not stupid.
Yeah, but the way the Chinese economy is growing, I mean, it's still going to be big on manufacturing, but their own plans to build the economy is, you know, to build a services economy that is not so export focused, and it looks like, you know, building up its own middle class and the wealth that they're getting from, well, producing everything for everybody else. But, you know, the other major driver in China is the pollution levels as well. And the Chinese government wants to stay in power, and they won't, you know, with the level of the pollution and concern that's going on now, they get unrest if it continues to be so. So I'm sure that's figuring very strongly in their motivations too.
I just want to sort of focus on a local issue with regards to, and I didn't quite catch what you said about coking versus thermal coal, but in Sydney we have longwall mining underneath the Sydney water catchment.
Yep.
And a lot of the companies are in trouble. We know, because a long time, I think the rhetoric was that it's such high quality coal, and it's not thermal coal, so it will be, the demand will be there forever. But can you just give a little insight into?
Oh, look, I've read the reports on that. I mean, it's just, you're just opening up a totally new series of issues that every mining company has to deal with, I think. You know, you can look very much and say which coal company is going to survive over the long term, or which energy, and its cost is certainly one. One thing that I really notice when I'm analysing companies or getting my fund managers to look at it is how well do companies address stakeholder concerns, community concerns on the types of projects that they want to get up and running. I mean, we see it with, you know, the latest great ones are AGL and Santos with their coal seam gas. There's technical issues there. How well do they sell it to their local communities to get it on side? They're not doing it particularly well. There's big write-downs in valuation, and that's, you know, how ESG issues impact valuation. You know, coal world mining and water. Water is such a crucial thing that I think that people will be very careful before going too much further. And you know, you couple it on with social media and the capacity of people to form and get different forms of views going on. I think you've really got to be very smart in how you deal with these things, and we'll see which companies are. Is that sort of, I mean, is there anything that you want to...
I'll answer it in a different way.
Yeah.
I'm with Tony Abbott. I think a foreign private company will do the right thing. They're not going to contaminate Australia's drinking water. They're not going to contaminate Sydney's drinking water. They will do the right thing by us, right? I trust them. I trust Peabody.
Yeah, and then
If I could just ask another question, and it's about gas, and I wonder, because I think there's been a recent paper modeling gas in terms of climate change, and it basically said that it's likely to have very little impact because it's going to delay renewable energy incentives and things like that. So is sometimes this focus on coal actually giving gas a free ride until we actually go, uh-oh, we're still in big trouble?
Yes. But, you know, we've got a carbon budget, and I think that you've got to, you know, we've got a certain amount of budget that we can get globally over the next while to manage before climate change becomes dangerous levels. And so, you know, you've got to try and stretch that budget out as effectively as possible. You still have, all the, and you've got to get everybody along for the ride as well, and so you can't just get rid of coal and gas immediately. But I'm sure the same sort of pressures that are on the coal industry now will get onto the gas industry in the future.
So looking at the same precipitous rise
It's still...
growth and supply and everything else.
Yeah.
I was actually at a talk here 2 weeks ago where Beyond Zero Emissions launched their land use plan, and I think one of your colleagues was talking about fugitive emissions and methane versus carbon, and saying on a 20-year view, methane's 100 times worth, on a 30-year view it's 70 times worth. Then the science teacher came up and goes, so why is this 20 times worse figure used? And it's a globally accepted convention that we're going to use average over 100 years. We've got a climate problem in the next 20 years. Methane emissions are 100 times worse than carbon. So as soon as you start applying a methane emissions test on gas, gas is no solution. It's an obstacle to the transition, as you said.
Yeah, we've got two final questions.
Oh, okay, I'll see if I can squeeze in two quick ones. Firstly, I got here last, so I don't have to cover this already. In Victoria, I think it's a particular problem, these take-or-pay contracts that a lot of the mines have, where they basically have to pay the transport contractors even if they don't have to do anything. So just wondering what time horizon are these over, because obviously a lot of these the coal mines are actually making losses at the moment, but they still have to do this because they're making less losses by actually still getting something for their money back. And also the aluminium smelter has made the closing of that has made a huge difference in the overall energy market and the possibility of a debt spiral. So just wondering if you could talk about those factors and how they play. Is it just a Victoria-specific problem with those, or is it when do those contracts finish? And obviously that'll make a difference as well.
Yeah, the take-or pays are very prevalent in Queensland rather than Victoria. At the end of the day, my work's very much focused on export coal mining, because that is the marginal market that, when markets are booming, exports boom for Australia, but when the market then tanks, exports your first cutback. So Australia's building export capacity. A lot of these coal miners needed access to the international market, so as you say, they sign 10-year take-or-pays. So I mentioned Wiggins Island Coal Export Facility. That's not a picture of it, but that's what it looks like roughly. So this is Abbott Point. The Wiggins Island Coal Export Facility is a 10-year take-or-pay, and it means you either use it or you pay for it, because the banks have lent 100% of the value of Wiggins Island Coal Export Facility, and the banks usually get paid. So they have a bizarre situation. I mentioned Bandana Energy's being bankrupted, gone into administration. They had a $400 million liability to Wiggins Island Coal Export Facility. By the end of it, they're a $50 to $100 million company. So the directors are saying, well, we owe $400 million through this 10-year take-or-pay with a coal port that hasn't even opened. We're actually trading while insolvent. Cockatoo Coal's in the same boat. There are 8 coal companies who signed take-or-pays with Wiggins Island. It's a relatively new phenomenon, and it is absolutely part of why the coal price is tanking at the moment, because the coal companies, as you said, are keeping on pushing product out faster and faster in order to deliver on their take-or-pays to avoid actually losing even more money.
Can I just look at some quick questions into this lady? Something that I've been thinking about and hasn't really had much play. Recently, the World Health Organization classed diesel particulate matter exhaust as a grade 1 carcinogen, like the top level.
Yep.
So I'm just wondering if there's anybody factoring this idea. I did put this to one of the CEOs of one of our largest energy companies, and he looked a little perplexed with me, so I don't think he considered it, although he's probably considering it now. Is there a possibility that there could be some kind of class action in either, in China's obviously a different legal system, but India might be a possibility, a few other places, where there could be a class action about people's health being affected by an officially classified carcinogen? Is that a possibility that could possibly push ahead some of these processes that you're talking about? We saw what happened with tobacco smoking, which basically got banned from clubs overnight with one successful test case went through.
Yes, there's a possibility. I think that's, from my board's perspective, why they were comfortable, because no other super fund divests of lots of stocks in lots of areas is because of just you just know in the future that things are going to get tougher, be it regulation tightening or class actions or things like that. And you see, you know, that case I don't know exactly, but it'll play out. You see a hell of a lot more activism coming amongst shareholders and class actions and sorts of monies that you can get back as a shareholder, because you're just sitting there as a super fund invested in every company in the world, and a lot of those companies have these huge issues, and somebody else has made a profit along the way, and then you're just sitting there passively receptive as a superannuation investor. So there's lots of class actions going on in the States. There's over 300 cases a year. I think it's going to increase. I think they want to, I know that I've been approached to participate in more of them as well. So, you know, you just got to think, are they, you're just beating lawyers, or are they actually worthwhile cases? But most definitely, it's just another tool that you can start to use as an investor to try and moderate the behaviour of companies.
Yeah.
Apart from the direct investments in the clean energy sector, do you see there will be opportunities for innovative financial structures, products to facilitate this low carbon economy transition?
I would say categorically yes. I'm watching that with a lot of optimism. Interesting, Tony Abbott actually had to acknowledge the CFC existed in the G20. He's been trying to kill it for the last 2 years, and he actually mentioned it as one of Australia's triumphs. And to me, it is. I love the CFC. It's designed to enable new technology adoption in the local market. It's modelled on the Brazilian Development Bank. It's modelled on KfW of Germany, two of the most successful development banks in the world. Germany and Brazil have huge push into renewables, and they've got very effective marshalling of capital to help that drive. And they're both profitable businesses, very profitable. So I look at the development of the green bond market.
Yeah, that's what I'd say.
Yeah, as Bill said, there's $70 trillion invested in superannuation globally. It's a matter of marshalling that. You create the right instrument, and merchant bankers are very creative, right? Very creative when they're playing with other people's money, and they will create solutions. And billions and trillions will be allocated to this. That's what gives me the optimism. The green bond market's grown from 20 billion last year to 40 billion this year. Its target's $100 billion of new capital into the green market globally, and it's going global. It's going into Sweden, it's going to Chile, it's going to America, it's going everywhere. The Yieldco is a new structure in America. It's marshalled 20 or 30 billion dollars of assets in 12 months in the renewable space in America. It didn't exist a year ago. It's the hottest sector in the equity market in America. It's marshalling $20 billion. It's repricing upwards renewables dramatically. The average cost of equity for renewables in America is now 7 to 8%, 30% lower than the average cost of equity for the equity markets. That's fundamental. The cost of equity in Australia for renewables is 13, 14% because of the regulatory problems we have.
Yeah, look, the green bond market is phenomenal and is growing, and you know, I think there's great opportunities coming through because the governments of the world are cash strapped, so we know that. So there is a silver lining there as well.
What do you think of weather derivatives?
Weather derivatives? Well, I kind of like them. The returns are pretty good. My CIO says, why do you want to introduce more carbon risk into your portfolio? But the returns are generally about 7% and are at such a high level of the equity structure within the insurance industry that they don't, typically when a big storm comes along, they don't get hit. So I sort of say to them, well, we'll invest in catastrophe bonds and divest of insurance companies, but maybe I was being a bit too radical there. But look, cat bonds are growing, and I think they're proving themselves up quite well, but I haven't gone in there yet.
So we've had two excellent presentations and a wonderful discussion, which no doubt will continue informally. So please join me in thanking our speakers.
No, that's good. Whatever to have you here to back it up.
Yeah, no, it's all fun stuff. It's all proper style goods and all this.
For our eyes, no matter what. That was wonderful. I was hoping you'd join
Thank you so much.
To have such engaged audience as well.
I can't see how this can be kept quiet.
Yeah.
I mean,
Murdoch Press will be the last.
No, the AFR's
Australian
pretty
Financial Review.
That's 350's renamed them the Australian Financial Review. It's brilliant. I met Mike there 2 weeks ago and presented this to him. After 1 minute, he was bored stupid when we sat down. I went in with Steve from BZE, and he goes, "It's fine afternoon. I do not want to lecture on bloody electricity markets." After 1 minute, he's sitting forward. He goes, "Mate, I'm totally with you." And I go, "What are you talking about?" I barely started, and he goes, "I was up in China 3 weeks ago. It's opened my eyes."
ABC's up there. Do you want to come up? They're up at the top, they might get their cameras down. So we're just up there upstairs, You mentioned Institute of
I'll mention it.
Right, okay. Yeah, I'm going to put it online. I'll make it into a PDF. Well, just in our events, the IES, the IES website, the events page under your...
Phenomenal. So they're actually